started. In this section, we're going to be having a ABCD discussion. Now, before we begin with an honest ABCD discussion, I want to go ahead and give you guys the opportunity to identify a currency pair, a time frame that you'd like to discuss, because the process is going to be the exact same, but I do want to make sure that it's in an area that you may be able to apply immediately, or at least follow along, kind of get some hands-on experience with it. I'm going to share this ABCD rule document with you all in the handout section of your GoToWebinar control panel. Actually, I'm going to have that open as well. If you don't know what I'm referencing when I say handout section, you should have a GoToWebinar on your control panel. If you, hang on, I'll just screenshot the thing and I'll bring it here onto the any money bet that thing is hiding behind the worst possible place. Little control panel for snipping tool. It's so weird. Where is it? Okay. I'm going to move some stuff around here. I apologize for that. For some reason, my snipping tool control panel isn't popping up. There it is. Okay. So, here is the control panel for GoToWebinar. That's what it looks like. Right? If you can't see the whole control panel, at the very least you should be able to see this part of it. Okay, you should at the very least be able to see this part of it, and if you click on this red button, it'll reveal the rest of it. Okay, inside your GoToWebinar control panel, you've got this handout section, and that's where you're going to be able to find that ABCD rules document. That's what we're going to be talking about. Okay? So, Michael, you want to work with the Euro Kiwi, huh? Okay. So, is there a time frame that you would prefer? Charting, new chart, Euro Kiwi. 1 hour? Okay, 1 hour works. Any time frame, any currency pair is fine. When we take a look at the market, the first thing that we see is that the market is moving in waves. It's not moving in a straight line, although from time to time it does move aggressively. If you take a closer look at this, if you zoom in, you will see that there's points where the market does pull back. It's just natural market oscillations. And the way that we keep track of these, especially if you're not an ultimate charting software user, if you're not an ultimate charting software user, you have to pay a special attention to be able to plot these correctly. So what you're going to be looking to do is to be able to monitor these waves that the market moves in. And these waves are the Fibonacci waves. We use the Fibonacci tool to keep track of these A, B, C, D moves. In an uptrend, the market starts at the lowest, or the trend I should say, will start at the lowest low, and it will extend from that low to create a high. That's a high candle with 2 to the left and 2 to the right. Anybody not clear on what highs and lows are, by the way? If anybody in the room is not clear, please indicate that. If you understand what a high is, what a low is, then we will move on. Okay, cool. Rick, awesome. All right, so the market's going to extend from a low point to create a high, and then that's your A, B, that's your initial rally. Then the market is going to retrace or pull back. Right? So it's moving from the B to the C. And from that C, it's going to extend to a higher high price. Now, this is your basic A, B, C, D wave in an uptrend. All right, we're going to get into the specifics of this here in a moment, but this is your basic A, B, C, D wave in an uptrend. We are constantly, in its plainest form, in order to be able to trade this, we're simply looking to identify where C is to be able to get in at C and take the ride up to D in an uptrend. Right? Does that make sense conceptually? Everybody get behind that? You identify the AB. Once you find C, you get in, get out of D. Right? When that is completed, when that full cycle is completed, A, B, C, D, C is going to become a brand new A, and D is going to become a brand new B. And the cycle simply starts again. Because based on that new AB boundary, you're going to look to identify your new C. Right? What the market should do next is the market should pull back. It will pull back. You're going to identify your new C, and once you identify your new C, you get in and you take that ride all over again to the D. And again, and again, and again. And before you know it, you're participating in a trend. That's how a trend develops. Okay? In the downtrend direction, it's the same thing in the opposite direction. So the market starts off at a high, moves down to a low price, pulls back or retraces, and then extends to create a lower low. A, B, C, D. Any questions on this? Anybody feel in any way unclear with what we've discussed? Okay, so let's actually apply this to a chart. Let's talk about the actual technical matters that we need to be paying attention to. Because usually this is where all hell breaks loose, right? It's all fine and good when we take a look at a nice little drawing like that, but actually popping it onto a chart, that's a different story. So, first things first, let's take a look at the chart. Based on what you see here, this is as far back. I want to compress my chart and see everything that there is to see on the chart. The first thing that I need to do is identify what the actual trend is. Okay? So, if you take a look at this, what would you say the overall trend direction appears to be? Does it look like it's consistently going down, making lower lows and lower highs, or does it look like it's going up, making higher highs and higher lows? Okay, I'm getting conflicting information. Some traders say up, some traders say down. Okay, so, and that's going to happen, right? That's going to happen, and I understand why that is. What we have here is, historically, there's a long period of time where this market was moving in the direction of the bears, and there is a short period of time, relatively close to recently, where this market started moving in the direction of the bulls. So this is the first point of contention. What I want to do is, because the reality is, I don't necessarily know. I don't know for a fact that I have a giant AB boundary where this is simply the retracement to a really deep C and I'm going toward the D extension, right? That may not be the case, but I don't know this for a fact, because the market was making lower lows and lower highs for longer than it's been making higher highs and higher lows. If I identify the absolute highest high of this entire chart, it would be here. And if I identify the absolute lowest low of this entire chart, it would be here. And the only trend line that I can draw between those 2 points would be a downtrend line. Does that make sense? My downtrend line would have to go across all the highs of resistance before the lowest low. Trend line always goes between the highest high and the lowest low. So I agree that we have a trend line break right here. Right? We've got the market breaking the trend line. What I don't know for a fact is whether or not this trend line break caused an actual trend reversal. And that's what I'm going to find out. Does that make sense? Michael says, question, how do you know the first low after the B if it's at, let's say, the 5-0, then starts to go your way, but then pulls back again? Oh, okay, Michael, you're talking about how to determine the C. We're going to talk about that in a minute, Michael, but to answer your question right from the get-go is you don't. You just don't. And you never will. All right? But I'll explain why. Let's take this in steps, shall we? Here's the downtrend that we've identified, right? We don't know for a fact. The only way to confirm for a fact is we want to have, in order to determine an appropriate reversal, we want to have not only a trend line breaking, but an A, B, C, D being taken out as well. Right? So I have to have these two things occurring so that I know for a fact that I've got a reversal on my hands. Right? Not just a speculation, not just because I feel like it. I know it for a fact, a confirmed fact. So I want to have the trend line be taken out, and I want to have the capital A, B, C, D be taken out. So I need to be able to track this trend. The way that I'm going to do that is by starting at the origin of the trend. Now, if you reference that document, we've got A, B, C, D rules for an uptrend, A, B, C, D rules for a downtrend. Which would you say are the applicable rules right now, based on the information that we're dealing with right here, right now? Downtrend rules, right? Downtrend rules. So if that's the case, because the trend that we're trying to identify, we want to figure out whether or not this is over. So the trend that we need to identify are the downtrend ABCDs. Downtrend rules state that I'm going to begin at the highest high, that's going to be my first A, and I'm going to go to the first low. Highest high to the first low in a downtrend. That's how I identify my first AB boundary. So I'm going to get rid of everything that is not the highest high and not the lowest low to make sure that I am plotting this correctly. And to aid you in identifying these highs and lows, there is an indicator, right? There's something called the fractals indicator. So I can go to my indicators menu, and under indicators I can locate the fractals, right? And if I turn on the fractals, it'll give me the main series, which points out the highs, and the down series, which points out the lows. So I can have my highs whatever color I want, and I can have my lows pointed out in whatever color I want. I'm going to use arrows instead. Okay. So when I click on OK, this is actually going to point out these highs and lows for me across the chart. All right? So once again, I'm getting rid of anything that is not my highest high, which is right here at my first low. This is my very first Fibonacci. First highest high, 2 to the left, 2 to the right, not as high as it. First low, 2 to the left, 2 to the right, not as low as it. First AB area. And I'm going to draw my Fibonacci's to make sure that I'm working as exactly as possible. I'm going to use the magnet tool as well. The magnet tool will attach whatever it is that I'm drawing. It's going to attach it to the high or to the low of whatever the candle that is highlighted. See how the candles get highlighted in red as I move my mouse? Whichever highlighted candle, the magnet tool will attach to the high or to the low based on the position of the mouse. If I'm above the candle, it will attach to the high of that candle. If I'm below the candle, it's going to attach to the low. So I'm going from the highest high to the first low. So I'm going to bring my A, start there at that high above, and I'm going to bring this below the candle to attach to the low of the first low. That is my first A, B boundary. And I'm going to identify that AB boundary with some horizontal lines. Any questions on what we've just done so far? Do not be afraid to compartmentalize Eliminate all of the unnecessary and allow only the necessary to speak. If that's what it takes for you to build up your spatial intelligence, some of us are better at it than others. If this is what it takes, get rid of all the other crap. It's very difficult to analyze the market if you're being confused or your eye is being drawn to current. Right? You can't place a position at current if you don't understand what the market has done. Because by understanding what the market has done, you can predict what it's going to do. That's the whole point. That's technical analysis. That is the whole point. Okay? So, here's my first down AB boundary. What I'm looking to do is progress to step number 2. I want to find the C, like we talked about, so that I can get in at C and so that I can get out at D. Any questions on that? Okay, so if that's the case, then let's continue. C is going to be the nearest point to the A price after the B. Okay? You would not believe how many traders this throws off. And it just does. Right? It's not anything to be embarrassed about. It just happens. There's a lot of stuff to juggle here. It's not something that we're used to doing on our everyday existence. Right? So, what I'm going to do then is, since C must be the nearest point to the A after the B, the very first thing that I'm going to do is I'm going to put a line at B. So that I don't make the mistake of looking anywhere back here. Because anywhere back here is irrelevant. The B and the C cannot be the same candle. C will be the nearest point to the A, so I'll label my A-B boundary. Here's my A, here's my B. And the C needs to be whatever point is closest to the A after the B. So if that's the case, based on the information that we can see right here, would you feel comfortable in saying that you can identify a C? If you have an AB boundary, the truth is that you have a C. You always will have a C. Doesn't mean you have an entry, but you've got a C. Okay? So, if I start from my A, if I were to take a line, take my crosshair tool, if I start, this is my A, right? We said C is going to be the nearest point to the A, which is this price right here, 1.5763. So C is going to be the nearest point to the A after the B. So in here, whatever is closest to this price after the B. So if I start from A and I work my way down, then that means whatever touches that first, boom, right there, that's my C. That makes sense? That's my C. This, the AB boundary, and even beyond it, is a playground for the market. Okay? So Doreen, here's my A-B boundary. C must always be the nearest point to the A after the B. If I start from A, here's A, right? This is my A price, 1.5763. And I want to go after the B. This is my B down here. So I want to make sure I'm after that candle, not looking at anything back over here because that's irrelevant. After the B, if I start at A, I work my way down. You see how the market, the first thing that touches that line is that wick right there? That's my C. Make sense? Okay. So B and C, as we discussed, since it has to be after the B, that means B and C can never be the same candle. B and C can never be the same candle. C and D, however, can be. In the event of a fundamental announcement, if the market were to, by any chance, we'll talk about the D extension in a minute, but if the market were to aggressively, let's say this candle is massive, and it nails the D target and then gives me a low in the direction of the trend, right? So this is now a low. Has anything changed within the constraints of this AB boundary? Can we say that there is a closer point to the A after the B? No, right? This is still the closest point to the A after the B. And if this market fulfills the D extension and then creates a low with 2 to the left, 2 to the right, this is the D extension has been satisfied. The market has created a low. C and D can be the same candle. Does that make sense? This is not something that happens often, but it does satisfy the rules. So if you see it, it is what it is. Okay? C and D can be the same candle. Now, here's where things start to get complicated, right? A and B are constants, right? So this is my AB boundary. And the market, this is my playground for the market. Remember, the bulls and the bears are fighting, constantly fighting for control of the market. So inside this, maybe even outside of the AB boundary, the AB boundary is going to remain active, and it can remain active until the end of time. We hope not, but it can. This will not change unless one of two things happens. We'll talk about those in a minute. The C, however, is a variable. And the reason why the C is a variable is because C must always be the nearest point to the A after the B. So this is where my C is right now. If the market decides to come up closer to the A, my C must change. Does that make sense? Just because of what C is, what it has to be. So if at any point the market decides to pull back closer to the A, I cannot insist that this is my C because this is no longer the nearest point to the A after the B. Period. The AB boundary does not change unless the C retracement takes out the A, and that includes touching the A price. If the market touches the A, that is a 100% retracement. These Fibonacci retracement levels are not only random numbers, right? The 382, the 50, the 618, the 786, they're not random numbers. They are percentages of this total AB value. And they also give you the exact price point which qualifies a C as that level of a retracement. The exact price point is written there. Okay? So if it doesn't touch that price point, it will not qualify as that level of a retracement. Based on the depth of the retracement, based on how deeply this market goes into the AB boundary, we project where it's going to go. We're just following the bouncing ball. Right? So if I were to bounce a ball every time with the same amount of strength, would it be fair to say that that ball is always going to bounce back up to the same area? If I bounce that ball into a hole, the ball has expended more energy going deeper into the hole, so it won't be able to come up as high. If I bounce the ball off a table, it's going to be able to go higher because it expended less energy on the way down, so it's going to go higher still. All we're doing is following the bouncing ball. A, B, based on the C bounce, where's it going to go? right? So, based on the C retracement, and every single one of these retracement levels has a projected D target. They're color-coded to help us memorize. If it touches any one of the red levels, expect the market's going to go to the 1.618 to red. If it comes deeper and touches the blue, it's expected to bounce out to blue. If it comes way deeper to the green, then it's only expected to be able to make it to the green. Seems simple enough? The question that usually follows is, what happens if it goes past it? It doesn't really matter. Because if you've gotten in at C, you've targeted the appropriate D. So as far as you being paid, it doesn't matter. You'll have made the money anyway. Does that make sense? If it goes past it, that's the market's problem. From a simplicity standpoint, we identify the C to project the D. Any questions on that before we move forward? Okay, so once again, A and B are constants, only the C is a variable, and the A-B boundary will change if the market takes out the A. That's factor number one. If the market manages to take out the A, that is cause for a reversal. We're going to be looking to change the direction of our Fibonacci's if that happens. We'll come to that later. The second reason for me to change the A-B boundary would be if the market satisfies the D target. All right? If the D target is fulfilled, and the target is based off of the retracement level like we just discussed, if the D target is fulfilled, I'm going to wait. In this case, this is a downtrend, so the market's also going to have to not only satisfy the D extension, whatever the projected D target is, it's also going to have to give me a low, a confirmation that the ABCD is over. If it's an uptrend, the market's going to have to give me a high. Okay? But if it satisfies the D target, then my old C will become a new A, and my old D will become a new B, and the process starts all over again. Everybody feel comfortable with these rules? Okay, so here's my first AB boundary. Let's give this a spin. Here's my first AB boundary, and we've identified correctly the C retracement right here. This is the nearest point to the A after the B, so boom, there's my C. Based on this level of retracement, what is the D extension? What is the appropriate D extension target? Is it the 1.618, the 1.27, or the 1.18? It's the 1.618, right? If it's right here touching a red level, it hasn't yet touched the blue level, so the projected D target is down here. Here's something else that tends to nail traders. If this market were to come down here and create a lower low, but does not satisfy the D extension, do I draw a new ABCD? Absolutely 100% no, right? Because the only reasons why I would look to change my AB boundary is if the C takes out the A or if the D extension is fulfilled. If the market just so happens to give me a lower low, well, that's fantastic, but I don't have a new AB boundary. Unless it satisfies the D target, I cannot redraw my A, B, C, Ds. So, here's the market. There goes the market starting to move in the direction of the bears. Here's a lower low with 2 to the left, 2 to the right. Does C become A, D become a new B? No, there is no D. This is where the D target is. And as of right now, the market has not touched it. Okay? Market continues to move, continues to move, continues to move. There is my D target being hit. Do I draw a new ABCD now? Absolutely not. Okay? Absolutely not. Because I need the confirmation that this move is over. When I get a low of 2 to the left and 2 to the right, right here, this is the completed ABCD. This is known as the actual D. I can't help that. If the market does that, exceeds the projected D extension, I can't help it, but I must wait for the actual end of the move. As far as if I got in selling the market at C at the bearish signal that occurred after C, at one of the bearish signals that occurred after C, if I got in selling, my target was a D extension. So I got out profitable anyway. Doesn't matter that the market exceeded the projected D extension. As far as drawing my Fibonacci's correctly, I need to pay attention to the actual D to be able to draw them. So my actual ABCD swing is this. AB, B to C, C to D. Questions? Doug says, are your sessions being recorded? Doug, yes. We're starting from scratch, right? With the new Analyst on Demand location. We're starting from scratch and all of this is being recorded. This is the first session. It's still ongoing, so there's nothing really to post just yet, but it will be posted moving forward. All right, you're very, very welcome. Very welcome. So now that this has been completed and confirmed, now we can move forward. My old C is going to become my new A. My old D, the actual D, is going to become my new B. And I'm going to move my lines to identify my boundary. I'm not looking for anything in front of this. This is my new AB boundary. And this is my new Fibonacci. A, B. By default, since there are so many red levels, it's just by sheer probability, right? It's more likely that this market is going to make its way toward the 1.618 D extension, right? So by default, what you will usually see me do is I will usually, if I have my target line, I'll put that target line, once I can select the thing, it won't, there we go. I'll place that target line, oh, the magnet tool's on. I'll place that target line at the 1.618. Okay, just usually you will see me do that. Right? It's not yet time for this, but based on this information, can we identify the C? Where's my C? Do I have a C? We're not talking about entry, we're just talking about how to identify the ABCDs at this point. Do I have a C? Bet I have a C. I always have a C. There's an AB boundary, I have a C. Right? Because in order for me to draw the AB boundary, I need 2 to the right. So there's always candles to the right of the B. Right? There's always candles to the right of the B. So if that's the case, I'm going to take a look at which one is closest to the A after the B, and that's going to be my C. So I can take my crosshair tool, start from the A if I must, work my way down until I get the first one that touches. Boom, there it is. This is my C retracement. Now, Rick brings up a very, very good point. Rick says, super shallow. Rick, that's excellent. This is indeed a super shallow C retracement. And there's a special rule when we're talking about shallow and super shallow C retracements. Anything that is less than the 382 is considered a super shallow C retracement. If it actually touches the 382, then it's considered a shallow C retracement. And if it touches the 50 or beyond that, we're now in deep C territory. The reason why this is important is because if we're in this area, there is a certain rule that we observe. Whenever the market has given a shallow or a super shallow C retracement, the 80-20 rule is in play. And the 80-20 rule states that whenever you have a shallow or a super shallow C retracement, there's actually an 80% chance that the market's going to want to go deeper to the 50 or beyond, and only a 20% chance that the market's going to shoot out very aggressively toward the 1.618. All right? So right off the bat, we know that most of the time this market's going to want to give us a deep C, a 50, a 618, 786, or an 86 retracement. And only 20% of the time the market's going to make an aggressive move straight toward the D extension target. You're going to consider if and when you start looking at entries, you need to consider what your equity management is, right? And whether or not you're looking to participate, whether or not you're interested in participating with that 20%, right? But most of the time, the market's going to pull back to your 50s, 618, 786, 86. Any questions on that? Okay. So, if this is my C, what's my projected D extension target? $1.618, perfect. So again, I'm going to be expecting this market to head toward that direction. If this happens, is there anything that I need to be paying attention to within the constraints of my AB boundary? I am constantly monitoring the market's position with respect to my Fibonacci, right? Because I want to see how deeply it bounces so that I can project, or how deeply it retraces so that I can project the expected bounce. So this market, perfect, has now gone to a deeper level, nearer to the A after the B, right? So I would change my C. What some traders do is once they've identified their C, you may choose to even put a line at the current C. If you find that you're really bad at identifying your C, you may, once you identify your first one, put a line at it, and if later on you see that the market has broken that line again, oh, I've got to do a C. Okay? Has my AB boundary changed in any way, shape, or form here? Not at all, right? Current C is still intact, and the projected D extension target is where it's going. Okay? So, here the market has broken the line, it's gone to a higher price. We readjust the C retracement, the projected D extension target remains the same, right? Because we're still within the red area. As long as the market has retraced to red, it's expected to extend to red. And this is all tracking the ABCDs implies. Okay? Now take a look at this. Do I draw a new ABCD here? No, right? Why? Because the Fibonacci is actually giving me my D price. of 1.5469, 1.5470 roughly. It's telling me what the actual price is. If I take a look at this low, it's just the arrow, right? The indicator that's telling me. This came down to 1.5469. 693. Okay? If it's within a single pip, you can accept it. Okay, if it's within a single pip, you can accept it. For me, I prefer to see this get hit. Okay, I want to see it get hit. There's my D extension being fulfilled. 2 to the left, 2 to the right. This is my actual D. So I have my ABCD swing, A, B, B to C. You don't have to draw these lines, but you can if you want to. It'll help you keep track. C to D. If you don't want to keep your Fibonacci's there and just want to see the swing lines, you can keep that. All right? So now that the actual D has been fulfilled, what happens? Absolutely correct. Right? Absolutely correct. C becomes A, D becomes B. And I've got myself a brand new Fibonacci here. C becomes A. Actually, let me get rid of that. C becomes A. The actual D becomes my new B. And I can draw myself a new Fibonacci. All right? From the high to the low. Anybody feel uncomfortable in any way, shape, or form with the information that we're discussing? Anything here unclear? Anybody feel like this is beyond them? All right. So we're going to come to a stopping point here. 2 to the left, 2 to the right. We're going to come to a stopping point right here. And we're going to resume this in the next segment. Except in the next segment, we're going to be talking about some of the things that we keep in mind in order to be able to determine an entry into the market incorporating your A, B, C, Ds. All right, we're going to discuss that when we return to the next segment. This has been Will Gomez, FX Showtime. I'll see you all at 10:30 p.m. Eastern Time. 10:30 p.m.